I have the absolute pleasure today of introducing to you Reece Birtles, Chief Investment Officer of Martin Currie, Australia. I've known Reece for many years. Actually used to be a client of mine when I was at Citigroup as an institutional equity advisor. Now, Reece, welcome to Pizz-Spectives. To give listeners a bit of background about who Reece is, Reece joined Martin Currie in 1995 as an analyst, took a short stint over to Europe, and was then recruited back to Martin Currie in 2006, where he was appointed the Chief Investment Officer and has had that role since. So welcome, Reece.
Morning, Rob. Thank you.
Pleasure. So before we do start, I do need to highlight the general advice disclaimer, which any information we discuss today is general of nature. Anyone acting on that advice does so entirely at their own risk. So please go and seek financial advice. Now, Reece, it's fair to say in that 30 years, you've seen a few cycles. Can you talk about a little bit about your history there?
Yeah, sure. I started, I guess the predecessor firm name was JP Morgan Investment Management in Australia in 95. So I'm just ticking over 30 years this month. It's certainly been a very interesting journey in terms of cycles. Obviously, one of the first really defining ones for my career was going into that tech bubble in 98, 99. And just seeing all that enthusiasm leading up to March 2000 and how that unwound over the 2000s in terms of really value investing. There's a lot of academic support for it over the long term. For a lot of investors probably today that haven't been around as long, they've experienced what you can only describe as being a very tough period for value investing since the GFC, where it's been more volatile than average and returns have been tougher. But the experience in the earlier 90s and the 2000s was really one of value investing gives you less risk, lower volatility, less market correlation, and better returns. And that's because it was such a period of exuberance. Whereas given the GFC in 2007, 8, 9 sort of period, a lot of value stocks tended to be more risky names, the ones that became really discounted in the market. And everyone's just framed themselves in the last 15 years on growth is the only way to go. And index investing has really picked up massively over that time period. And we're having debates about what price do you sell Commonwealth Bank given passive inflows, and people are starting to go, there's no price. It could go to $400 on index buying effect. Now, clearly when people start to say there's no price to sell a stock, that's got to be a bubble.
It sounds like it. I know I did mention to you before we started recording that there's a famous Mark Twain saying that goes along the line something like this, that it's not what you don't know that gets you into trouble. It's what you know for certain that just ain't so. And like you started the conversation with some similarities to the tech bubble back in 99, 2000. You're feeling some similarities to the current euphoria and enthusiasm towards that kind of space at the moment?
Sort of, it depends on which sort of factors that you're looking at. I don't think we're at full exuberance sort of period yet. When I look at market levels, like a cyclically adjusted PE or level of normal earnings versus price, I don't think world markets are as expensive or as exuberant as they were at that time. I think when you drop a level and you start to look at how cheap are value stocks compared to growth stocks in the market, for example, we look at what's the valuation gap between those, we are at pretty extreme levels. I'd say the beta is a bit less extreme, but arguably some of the alpha opportunity is as extreme. And so I would say over my career, we had tech bubble was an extreme event. GFC was an extreme event, but as a crisis rather than as a bubble.
Yep.
Then we had 2012, the European debt crisis was another bit of a crisis sort of event. And then you had the 2015 China growth crisis. They were a bit smaller, those two. And then you had COVID around sort of April 2020, March, April 2020. That became a really extreme crisis event. So they're the time periods that I've seen that you'd say that really the biggest valuation dispersions between value and growth have occurred. And today we're fully in one of those style events. We're in a COVID, GFC, almost tech bubble style extremity in terms of that. And we look at that on valuation ratios, but you can also look at that on index concentration, be it the Magnificent Seven in the US, concentration of the S&P 500, the Commonwealth Bank index concentration in Australia. These sorts of measures are what really telling you that what I would describe as a breakdown in market diversity. To me, efficient markets are when there's competing forces between value investors, growth investors, quality investors. We're having a battle to set the right price for a stock. When the battle is won by one of those cohorts, that's when you get these real breakdowns in price discovery and you create these valuation dispersion opportunities.
Yeah. And so you talk about those dispersion opportunities. How extreme are they on valuation at the moment, like on your analysis?
So we would say, if we look at, say, a value style portfolio, so how cheap is it compared to the ASX 200? On average, over time, that portfolio is about 20% cheaper than the market. You're always buying undervalued stocks. So it's never going to get to zero. But we're at 45% currently. For us, a more than 40% spread opportunity is when you're in full opportunity. And we've only seen that in GFC, COVID, and tech bubble are the only times we've had that extremity. And that's we're in a period of valuation dispersion that you see less than 5% of the time. So for us, it's a once in a decade style opportunity.
Yeah, okay. And I've always of the view that no matter in what stocks or sectors you're exposed to in a market correction, that everything falls at the same time. Is that your experience as well?
It's quite amazing when you go back and have a look at something like the tech bubble. So in the 12, 18 months leading up to March 2000, things like value indices only rose 10, 15% versus growth indices rising 20, 30. There was a cost on the lead up into that. But the differentiation in performance post March 2000 is incredible. World markets down 40% over 2 years. Australian growth stocks down 40% over 2 years, but Australian value stocks up 30% over 2 years. It's quite a sort of remarkable to think when you see that the world, I would say, is all in at the moment, right? Everyone's making money, 2 years consecutive of 20% plus returns out of the S&P 500. You go, where do you find diversification? And it's not clear that you can even find it in fixed income markets necessarily, because there's a lot of credit spreads that can be quite narrow in a number of areas. But value stocks have proven to be that real insurance policy in a market correction. And that low diversification, they had a beta of 0.7 versus markets in that correction period. So not only good returns, but good insurance. And I think when markets going up, no one cares about insurance, right? But it's important in building a portfolio.
At the same time, when markets go up, sometimes people get frustrated by the lack of performance from value stocks and feel like they shouldn't be there, and they chase growth and probably pushes the momentum even further. So as we look ahead, tell us a little bit about how your portfolio is constructed at the moment. Are you seeing opportunities in this space? Do you see value?
So our equity income portfolio has 6.5% expected dividend yield. We would expect dividend per share growth on the types of names that we would argue are quite defensive, low risk names is in that 4 to 5% category range. So we're looking at 10 to 11% expected IRR on a buy and hold portfolio. That is very much in line with our long-term averages. So we don't see that overvaluation in those sorts of defensive names. And the risk profile on the portfolio is as low as it's ever been. We're running at a 0.8 beta, 80% of the risk of the broader market, and to achieve those returns. Whereas when you look at broad market indices, we would argue those expected returns are much lower given the valuation starting point on PE ratios or yield currently.
Yeah, okay. And we also discussed a little bit more around, you mentioned earlier, passive funds and how it's low cost, low. I'm of the view, and I'd love to hear your thoughts on this, that active management does play that insurance or as that insurer, because you don't have that beta of one. So if the market falls by 10%, then you're generating a 10% decline. So can you talk us a little bit about your views on ETFs or passive versus active?
They've clearly been amazing in terms of attracting flows in recent years. I think one of my real concerns would be that whilst it's considered passive and index, people change the indices they're invested in. So they're becoming active investors in terms of which indice they're chasing. And clearly at the moment, we're hearing lots of people moving towards, say, S&P 500 indices. That's not passive, right? If you'd owned the MSCI World and held your allocation, that would be one thing. But you're making a decision that those 7 stocks in the S&P 500 that are driving the market are good if you buy that sort of passive index. And then when you get to an Australian example, when I think about building the equity income portfolio and minimizing risk, you have to realize that the index is far from diversified or risk free. The top 5 stocks in the ASX 200 now are nearly 35% of the index.
Wow.
Right. So there's massive concentration into 5 names. We're building as an active manager, the equity income portfolio that has about half that concentration in its top 5 names. Around 20% of the portfolio is in our 5 largest names. People have been sold the idea that index is the low risk way of investing. But in many ways, you're actually buying this massive concentration risk. And given the flows into ETFs, and flow allocation is very much driven by market sentiment. So there's a lot of flow into equities. When markets are bullish, people have to keep their equity allocations up. That's actually driving those concentrations and increasing risk in the index. And yes, it makes it hard for active managers whilst that effect is occurring.
Yep.
But as soon as the market dynamic changes and people start deallocating to equities, all that concentration risk is just going to come out the other way.
And just as a reminder for the listeners, the 5 stocks you mentioned, that I'm assuming are the big 4 banks and BHP.
Yep, that's pretty much. Yep.
Yeah. And so if you were to include the next 5, would that almost make up 45% of the market?
Yes.
Yeah.
You get to top 20 and you're talking near 70% of the market.
Yeah. Okay.
Top 10, you're talking 50% of the market. So it's a very extreme numbers. Now, see, in the US, they're really focused on that Magnificent Seven sort of concept and the concentration, but our concentration is much higher again.
Yep. Okay. So now looking forward and all about portfolio construction, we're in this, feels like, depending on which state you're living in, is dependent on how you're feeling and your sentiment is towards a recession and the like. Given we're Victorian based, it feels like we are in a recession, probably are. But looking forward, how is the portfolio position and what are some of the key themes you're looking for in this reporting season?
Sure. We would say we've been in quite a distorted economy when you get to, say, economic growth, employment, inflation, how it affects company profits and who's doing well. Business conditions is probably the best measure in Australia. If you look at the National Australia Bank business conditions, and we've come from extremely positive levels to around neutral. So we keep talking about this slowing, and it's slowed, as you say, in more some areas than others, but we haven't gone into bad conditions. So even though things like sentiment might be quite negative, the actual broad operating conditions, the capacity utilizations of companies has come from extremely positive to neutral. And so we keep saying our sort of view is be a little bit careful what you wish for. Everyone wants inflation to come off, but the employment market's coming off. It has meant that nominal GDP growth for Australian companies, nominal GDP, which drives sales growth, is around only 4 or 5%. When inflation's sort of around 3, you're really looking at zero real growth. And that's not a great situation for companies. Their selling prices on tradable goods is near zero. Their inflation on their services in terms of how much they pay staff is more like 4%. So it becomes quite a difficult combination to drive EBITDA margin expansion. Broadly coming into reporting season, expectations are that earnings growth is near zero. Resource commodity prices have been relatively, soft. So there's some negative growth in those sorts of areas. We think that defensive sectors, so be it real assets, some of the sort of more staples area, infrastructure, some of the non-bank sort of financials, that's where your best opportunities are to have above market of zero growth at the moment because things are quite difficult. Clearly, big issues for the consumer. Sentiment has actually bounced quite a lot in terms of the consumer sentiment surveys, but retail sales are only around 2%. So it's very hard for the companies to deliver good profit growth in that environment, in that consumer discretionary space, and even the supermarkets. Resources, we're seeing quite a spread there, right? So commodity prices, stock price performances are quite weak. There's quite a bit of concern around China and Trump tariffs and what that might do. And the stimulus just hasn't delivered out of China, but stock prices have no expectations for that now. A tariff comes in, China comes out with a big stimulus, that will be very positive for things like BHP. So we're a bit more positive on some of those resource names than we normally are. We also, some of the names like Ampol, there's refining margins have come off a lot, but we expect that's there. We're fairly cautious on discretionary. There's a few names in the market like Combank, Wesfarmers that are near zero growth and are now trading near 30 times earnings. And it's just very hard to justify how they can hold that sort of valuation. But then you get to things like a Transurban, and we expect they'll have probably an upgrade on their traffic numbers. Traffic's been relatively weak in recent years, but as roadworks are finishing and you're getting return to office, so they'll be delivering 5 to 10% growth, which we think is really good in this sort of current environment.
Okay. And if you could look into the crystal ball over the next 12 months, you said that the portfolio should deliver 6.5% roughly fully franked divvy plus 4 to 5% growth. So they're circa 10 to 11% total return for the portfolio for the equity income fund. The broader market, you did say 0% earnings growth. I mean, that in my opinion, that's probably across the bank. So you're already up against some headwinds for the broader index, and hence why active managers should outperform in this market.
Look, it's one of those rubber band things is really the way I describe it. Every day we're waking up right now and we're just seeing momentum stocks go further on the US or passive inflows or whatever it is. So there will be something that changes that. And when that rubber band gets stretched too far on valuation spreads, that's when you'll really see those differentiated portfolios do significantly better than the broader market. And that's our expectation. Whether it's when we look at these sorts of events, they tend to last between 11 and 18 months. I'm not giving you a 1, 2, 3 month outlook, but on a 12 months plus outlook, that's the expectation I would have.
Okay. And then even while we ride through some volatility, we should still expect a 6.5% fully franked dividend for investors.
I mean, for us, especially for retiree sort of income style portfolios, delivering on the income means you're covering your cost of living in terms of having the income, and you don't have to sell down the portfolio to be able to fund a lifestyle. And, that's what matters when it get tough. In bull markets, everyone's just worried about how do I do 20% returns. But when things get tough, it's how do I get that 6% yield is really what matters.
Yeah, no worries. And then finally, Reece, just to promote the fund itself, where if anyone wants to find some more information, who can they contact or where should they be looking other than myself?
Yep. So the Martin Currie Equity Income Strategy is the fund that we have. You can contact Franklin Templeton. You can go to the website franklintempleton.com.au and look for the Martin Currie Equity Income Strategy.
Legend. Reece Birtles, thank you so much for your time.
Thanks, Rob.